Morgan Stanley released their earnings results today, and how will the stock respond? Rising interest rates is generally a positive environment for financial stock, as higher rates usually mean higher profit margins for bank loans charges. Now, this earnings seasons, there is a focus on banks' net interest income reports. This is the difference between what the bank's revenue from interest-bearing assets are and the cost of servicing these assets. And investors are wanting to make sure that debt default expectations don't rise rapidly, just to assess how healthy banks' earnings really are. So what are the seasonals like for Morgan Stanley? Well, they are quite mixed. If you take from the 17th of Jan through to the 5th of February, you see that the average return is over 5% for Morgan Stanley, which really does look quite impressive. But when you use season axis feature in order to take out some of the key individual years, you can see here, if we just remove 2009, the average return drops down to 1.28%. So the results are pretty flat, really. So does this mean that Morgan Stanley is just worth passing over this earnings season? Using season axis seasonal pattern selector, it may well be worth just leaving. Or will the actual results reveal some hidden value, major trade risks? The main risk here, of course, is that Morgan Stanley surprised with some good results that causes investors to buy into the stock. Remember, HYCM clients can access the SeasonX product in order to analyze over 25,000 different currency pairs, indices, commodities, as well as individual stocks. So please do contact your account manager for a free trial to get started right away. Certain products and services mentioned herein may or may not be available to all clients, depending on which HYCM Capital Markets Group entity their trading account adheres to.